Hello, everyone, and welcome to this session on startup forecasting and Monte Carlo simulation. The reason for doing this session is because I was getting various questions from entrepreneurs, founders, and some of my friends in terms of how I have been doing forecasting and what are the different tools which are available for more accurate or effective or efficient forecasting. So in this particular session, I will be covering forecasting and financial ratios and how analysis of financial ratios is very important. And then I will be covering Monte Carlo simulation, where I'll be going through an Excel sheet, which you can also probably create for your own organization as well. And maybe, you can do a similar, more probably accurate and effective forecasting. So let's begin. We are all aware that consistent forecasting practices are very important, not only for the entrepreneur, but also for the investors, primarily because you want to evaluate business health and your risk associated with your businesses, and so do investors. They also want to value your business in terms of your overall existing business operations, your forecasted business operations, and also the risks which you face as a business. Another important point about forecasting is that if there is a detailed forecasting, it always helps. So whether it is forecasting related to sales, operating expenses, profits, or any other part of your business, as much detailed as you would be, it will help in terms of quantifying your risks in a much more better way. So say, for example, as a sales organization, you want to probably do forecasting based on a quarter-by-quarter basis. You can also do forecasting on a region-by-region basis or a geographic location basis. You can also do forecasting based on the product lines or different products, or any such ways. So whatever detailed forecasting you will do, that will help in terms of quantifying your risks further. Now, another important point is that evaluating forecasts with respect to the different components of balance sheets, income statement, and cash flow statements is very important, because they provide an in-depth view. And this is what we're going to look at when we are going to discuss the financial ratios. So there are a lot of financial ratios. There are hundreds of those financial ratios. They can be profitability ratios, liquidity ratios, solvency ratios. Some organizations also have efficiency ratios. Then you have leverage ratios. So from this startup perspective, I think let's focus on these 7 important ratios, because you may not have a historical data to calculate a lot of these ratios. So I think these 7 ones are a good start. Of course, you can add in more ratios as you go along. So the first one is a working capital turnover ratio, which is revenue divided by average working capital. Your net profit margin, which is net income divided by revenue. Your gross profit margin, which is gross profit divided by revenue. Then your operating profit margin, which is earnings before interest and taxes divided by revenue. Then you have cash flows to revenue ratio, which is cash flow from operations divided by net revenue. Operating expense ratio, which is operating expenses minus depreciation divided by gross revenue. And then finally, revenue to employee ratio, which is gross revenue divided by total employees. So I'll probably share you an Excel sheet and show you how this essentially will help you as an organization to analyze different ratios and what information it gives you as an organization. So this is an income statement for a hypothetical startup, which is ABC Limited. The founders have created a forecast with the total revenues over 5 years, from year 1 through year 5. They have total cost of revenues forecasted, and then they have gross profits they have forecasted. They also have forecasting done for marketing expenses, R&D expenses, general administrative expenses, and then they have calculated their income, earnings before interest and taxes, and then income before interest and after taxes as well. So let's see how, ratios they provide an information which probably you may not get just by looking at an income statement. So here are some of the ratios which we talked about in the previous slide. And if you look at this particular slide, so there are three ratios which we are looking in over here. So one is the gross profit margin ratio, then there is a net profit margin ratio, and then there is a cash flow to revenue ratio. Now, if you analyze it further, you will see that from year 3 to year 4, there is an increase in the gross profit margin, which is gross profit divided by revenue. It's approximately a 10% increase from year 3 to year 4, and then from year 4 to year 5, there is a small increase in the gross profit margin. But if you look at a corresponding net profit margin, you see there is a very sharp increase from year 3 to year 4, and then there is a decline from year 4 to year 5. So eventually what it says is that if your gross profit margins are increasing but your net profit margins are decreasing, then there is something happening either on the expenses side, or there is something happening in terms of your forecast. So it gives you an opportunity to actually evaluate your income statement again and your forecast again, and then see what exactly is happening, and whether you have a good reason to believe that okay, this will be the case, and this is the business reason why you think as a founder or as an entrepreneur it is important that this should happen like this, that it should increase from year 3 to year 4, and then it should decrease from year 4 to year 5. Now, another point which is important over here, which you might look at, is that there is an increase in the net profit margin from year 1 to year 3, but you are seeing there is a decline in the cash flow to revenue ratio. Again, so you need to look into your forecast again over here and see that if your net profit margins are increasing, then why there is a decline in the cash flow from operations. Of course, there could be a valid business reason, but it will be good that you analyze it further, evaluate it further, and see whether it matches with your business objectives and long-term plans. Going over to the second chart, and you will see over here that so this is the chart with the operating profit margin ratio and operating expenses ratio, and you see that there is a sharp decline in year 3, and there is a sharp increase in year 4 to year 5. Whereas if you look at your operating profit margin, you see that there is an increase from year 3 to year 4, and then there is a similar decline from year 4 to year 5. So again, this means that there is something happening in relative term as far as your operating expenses are concerned. So you need to look into it much more deeply in terms of why this is happening. Does it match with your overall business plans and business objectives, or there is some error, or you need to see whether your forecasts are correct. So my reason for actually sharing these particular charts was that you can evaluate for yourself how these financial ratios, they add value to your overall analysis, and they add value to quantify your overall financial risks. Now, to have the forecasting done in a right way, there are various tools which are available, and one of the most versatile and general framework for modeling any such kind of a situation that involves a lot of uncertainty or variables, that is Monte Carlo simulation. Now, Monte Carlo simulation helps you to forecast the probability of different outcomes where there are number of uncertain variables present. So let's say, for example, you have an uncertainty in terms of revenue. So you may have an uncertainty in terms of the number of units which will be sold every year. You will have uncertainty in terms of the price per unit at which you will sell to your customers. You might be providing discounts to some customers, you might be providing more discounts to some large customers, and maybe you will be selling at a list price to some of the customers. So there will be a lot of uncertainty as far as unit price is concerned as well. And then of course there will be uncertainty related to expenses, percentage of cost of goods sold. There will be uncertainty related to your R&D expenses. So all in all, there are a lot of variables, which are there. And what Monte Carlo simulation does is that it helps you forecast based on multiple variables and helps you calculate it much more effectively and efficiently, whatever outcome you are trying to calculate. So the beauty of Monte Carlo simulation is that you can not only use it for your business, which is for forecasting, but you can also use it for your personal decision-making scenarios as well. So let's say, for example, you're going to buy a property or you're trying to take a decision, you can actually do a simulation, for, as many trials as you want and see, what could be the probable outcome of, multiple variables which you are seeing while you are, trying to take that particular personal decision. So let me just share an Excel sheet over here and see how you, and let me explain you how you can do a Monte Carlo simulation. So again, this is a financial summary of another startup company, XYZ. And as you can see over here, the founders have forecasted total revenues, they have forecasted total cost of revenues, the gross profit, and then they have under operating expenses, they have marketing expenses, R&D expenses, general and administrative expenses, and then they have calculated earnings before interest and taxes and earnings before interest but after taxes. Now let's see over here how you can do a Monte Carlo simulation over here. So over here for this particular session, I have taken only 2 variables, but as I have explained in my previous slide, you can have as many variables as you want. You can probably add another variable, which is some percentage of total revenue, which is cost of goods sold cost. So you can have some percentage as that component as a variable. You can have a variable on your R&D expenses as a percentage of revenue, or maybe as some figure, random figure. Same goes for the marketing expenses as well. So you can add in as many variables as you want, and that's how Monte Carlo simulation helps to calculate your final outcome. In this case, it will be total revenue, and help you efficiently or effectively calculate it. So in this particular case, as you can see over here, there is a probable likelihood that the organization will sell either 100 units, 200 units, 300 units, or 400 units. So this is something which is the probability of how many units they're going to sell. And then there is an unknown variable in terms of revenue per unit. So there will be a range. So there is a range between which this organization expects to sell their product. So in this particular case, there is a range which has been taken between, let's say, for example, US dollar 1,470 to 1,530. Over here, I've just, in this particular case, it has calculated 1,500. So if I'll just do a refresh, this one keeps on changing. So So in this particular case, if you look over here, I have given equal probability to each of these scenarios, which is 100, 200, 300, 400. And here I have taken a random number between 1,470 and 1,530. So every time a simulation is run, this number changes to any random number, and then it calculates the total revenue divided by the number of units. Now, how those number of units are generated for each trial? So there is a random number which gets generated over here. And once this random number is generated, it looks up over here to which cell of units it corresponds to. So for example, over here it is 0.57. So 0.57 over here means 300 units. will be sold for this particular corresponding random number. So over here, what it is doing is that it is calculating the total revenue each time you want to calculate as far as your trials you want to incorporate. So let's say, for example, let me just show you how it is done. So let me just delete this. So okay, so you want to calculate total revenue. So let me link this table over here. So what I am going to do over here is I am creating a two-way table over here. I want to run 100 simulations for a random revenue per unit and a random unit, number of units sold. So let me just show you how you can do that. So first you need to create the total number of trials over here. So you need to add in, the number of trials which you want to add in over here. So you just go to series over here, you select columns, and over here you select up to 1000, and this will populate your number of trials over here. Now, because you want to simulate this particular formula, so you just select till where you want to run the simulation, go to data, go to what if analysis, go to the data table, and just select an input cell, which is an empty input cell, column input cell, and then click OK. And here you have a revenue figure for each of these trials. Now, what you can see over here, let me just refresh this one. So I have just refreshed this entire table again, and you can see over here that I have calculated the mean of all these trials or simulations figures. I have calculated the standard deviation. I have calculated the lower 95% and upper 95% confidence interval for this particular mean. So I can calculate it for each year based on the different variables. For example, over here we did number of units which are going to be sold each year, and what would be the variable revenue per unit. So this is the first simulation model. The second simulation model is based on a triangular distribution, wherein most of the organizations, they have a worst case, best case, and the most likely case over here. So again, over here also there is a worst case, best case, and most likely situation over here. And from these worst case, most likely, best case, we have calculated the lower range. So your lower range is nothing but most likely minus your worst case. Your higher range is your best case minus your most likely range, and then your total range is between your best case and the worst case. So Excel doesn't have the formula for triangular distribution, but you can always find these formulas on Google, on any of the Excel discussion forums. If you are not able to find it, just let me know, and I'll share with you the details over here. Now again, over here we are doing a probability over here, which we are generating every time, and then we have revenue per unit, which is a random number which is generating between 1,470 to 1,530. I have again done the simulation the same way I have done it in the previous model. So again, I have done over here 1,000 simulations for the total revenue, and these are the figures which have got generated over here, and these are the mean and the standard deviation values, and these are the lower 95% and upper 95% values for this particular triangular distribution simulation model. So before I get on to the financial summary back again, but let me just show you over here. This is how it calculates the mean value. So I've taken the mean values over here. So you can see I have compared the mean values for model 1 and model 2 over here. And then I have lower 95% for model 1 and model 2 and upper 95% confidence interval around this mean for both these simulation models. So now let's go back and go back to the financial summary. And now let's see how this thing works out. So as you can see over here, this was the original revenue forecast done by the founders from year 1 through year 5 over here. So I've taken these from here. And then these are the revenue figures which have been generated from the simulation model 1 and simulation model 2 over here. As you can see, there's a major difference in the revenue numbers for each year, and it grows as the revenue figures grow bigger. And if you look at the EBITDA figures, you see a completely different picture in terms of how the forecasts have changed. So so you can see that the Monte Carlo simulation helps you to look at a picture wherein if you simulate number of variables and see how they give you an outcome based on the different probabilities of different uncertain variables. It gives you a completely different picture and gives you a good understanding in terms of what risks are you going to face as far as your forecasts are concerned. So in this particular case, let's say for example you want to calculate the valuation of your organization based on your existing EBITDA. So let's take, for example, over here, let's not take the free cash flows, and let's try to calculate your valuation based on these EBITDA figures. And let's for the calculation purpose, let's take the discount rate as 15%. And let's take the terminal growth rate as 5%. Let me just change it over here. Just hold on. Okay, so let's do the valuation over here. And so to do the valuation, we first need to find out the terminal value of the organization based on the last year cash flow, or in this particular the last year EBITDA figures. So let's find out the year 5 terminal value. So we will multiply the year 5 figure by plus terminal growth rate divided by, let me just freeze this one, divided by discount rate minus terminal growth rate, and I get the terminal value for year 5 for all of these different forecasted figures. Now let's calculate the overall valuation of this organization. Now to do this, I have to do a discounted cash flow. So I first need to add in the year 5 value. So this will be this plus your terminal value, and you need to discount it back by, so let me just freeze this one, and you want to discount it by 5 years. So here you can see that I have calculated the organization value based on different forecasts, and you can see over here that there is a major difference among different forecasting models. So the point over here is that while you are doing your forecasting, please ensure to run it through different forecasting tools. Like, for example, in this particular case, go through the Monte Carlo simulation, because it helps you to take into account various uncertain variables which are there in your business. And in this particular case, we took just two variables, and you can take, many more variables as we discussed. And then, you can probably have a much more better forecasting as far as your business is concerned, and it will help you to understand your overall risk. If you have any questions, you can reach out to me. These are my contact details, and I will be happy to help you if you need any help. Thank you. Thanks a lot.